All right, everybody. Stocks by the numbers, welcome back. Today is Thursday. We have some earnings coming out before the close, about 90 minutes to go here before the market close. So I wanted to do just another quick little personal prediction video here for a couple of companies that some of you may be keeping an eye on or looking to play here after hours. Again, this is just my opinion. First company we're looking at, Exponential Fitness, ticker symbol XPOF, listed here on the New York Stock Exchange. Stock just got above $10 a share, up about a third of a point, roughly 3.5% on the day. Looks like everyone's kind of pumped about these earnings coming in. Estimates on the EPS side, 17.2 cents. On the revenue side, 81.7 million roughly. We can see class action lawsuit coming in on this company. Probably not going to affect this quarter earnings, but definitely not a positive, if you ask me. But let's look at the numbers here. Market cap 478 million. The company is losing money per share. The EPS looks like it has been climbing steadily for the last couple of quarters. However, the company missing 3 of the last 4 quarters on the EPS side. The revenue seems to be consistently climbing. So at first glance, in my eyes, it doesn't look like the revenue here is the issue. Obviously, the massive drop here in profitability could definitely be a red flag, with the company going from 33.6% net margin percentage profitability back here, basically same time last year, and you can see the margin basically just dropping off a cliff as of last quarter, minus 25%. Could get turned around. The company 81.7, so yeah, that would be another increase quarter over quarter in revenue, but again, when we see something like that, however, the stock's been getting beaten up like this for a while, in my opinion, we have to know to dig even deeper, look even further, because obviously there's something else that's going on, and the revenue is not enough. And first of all, we can see the EPS side appears to be the major issue for this company here right off the bat. You can see beating analyst expectations only one time in the last 8 quarters on the EPS side. So even though they're forecasting steady growth here on the profitability side, we kind of can't take their word for it. On the annual side, coming in above expectations for back-to-back years. The revenue side here, as you see, seems to be this company's bread and butter here. It looks like they are growing the business, and we can see we're expecting a slight dip back to 80 million here next quarter, but then we're jumping up to 85 and 88 million. So the company is expecting and forecasting continued growth. On the annual side, not too bad. 310 million. Looks like they have a good chance in my eyes to come in above that expectation. If they even come close to this number, that it would be probably like 315, 320 million potentially around that number. Yeah, maybe about 315. But we must keep looking. Price to sales now, the lowest it's been. Price to cash flow, the lowest it's been. Obviously, the stock has been getting decimated. Our return percentages have dropped down, but not the worst they've been. The gross margin percentage is actually the highest it's been, going back the last 7-8 quarters here, almost at 75%. Operating margin ticking up nicely here quarter over quarter, even though it has been bouncing around and it's not the highest it's been going back the last 7-8 quarters. Back up here to 16.65%, not too shabby. EBITDA, earnings before interest, taxes, depreciation, amortization, up here to almost 30%. That is the highest it's been going back the last several quarters. And we looked at the net margin percentage dropping to negative 25 as well. I'm seeing a drop here in the inventory turnover. The asset turnover looks like it has been kind of trying to steadily rebound here up to 0.59 now. However, of course, if we go back, we can see it was in a better position several quarters back. And we can see that these debt ratios have been consistently climbing. So it seems like the debt is the issue here, in my opinion. Also, first glance here, we can see the operating expenses, as you see, kind of holding those mid to high $30 million costs, and then in the last 2 quarters, that jumped up roughly 30%. Now we're in the high 40 millions. However, gross profit minus operating expenses yields operating income, and we can see that the operating income is actually up to 13.39 million. One of the best operating incomes going back the last 7-8 quarters. And now we can see where our red flags come in, right? So we have assets seem to be consistently climbing here up to about 551 million as of last quarter. Liabilities are really exploding here. You can see going into 23, going from that high 300 million mark, breaking right into the 500 million, high 500 million mark, and now as of last quarter getting up to 628 million. Assets minus liabilities yields equity. We can see the last 3 quarters the company now has negative equity, which of course negatively affects the book value per share, which as you see was bouncing around and then doubled back down, dropped down to 5, minus 6, minus 4, minus 439. So technically this has been climbing for the last couple of quarters, but in my opinion, definitely a red flag. And here we can see our debt as of last quarter, 411 million, market cap 477 million. In my opinion, I would not be a buyer of Exponential Fitness, and my personal opinion would be puts going into these earnings. Next company, the Beauty Health Company, ticker symbol SKIN, listed here on the NASDAQ, 346, $458 million market cap. We're losing money per share. Huge miss on the EPS side last quarter. 2 misses, 2 beats of the last 4 quarters on the EPS side. Revenue seems kind of sporadic here, bouncing around the 80, 90 millions, breaking above that 100 million mark, and then dropping right back down to 97 million. And now this quarter, 87 million. This is Q4, last Q4, 98 million. Now estimates 87 million. And also, you can see this time last year from Q3 to Q4, they had an increase in revenue, roughly 10 million quarter over quarter. And now we can see we're expecting a decrease of about 10 million here quarter over quarter. So even if they beat, in my opinion, I don't know if I would even view that as a green flag, really. But we can see the assets have been slowly ticking down, and it looks like the liabilities now have jumped up to the high 800 millions. That's the highest they've been in the last several quarters. Assets minus liabilities yields equity. We can see the equity now was several hundred million, dropping into the 100 millions, and now sub 100 million as of last quarter. The debt on the company roughly $750 million, with the book value consistently decreasing quarter over quarter, now dropping to sub $1 book value if the company closed its doors and had to liquidate everything in its name, worth about 68 cents a share. Stock right now 346. So with the debt being roughly 150% of the market cap value, in my opinion, I would not be a buyer of the Beauty Health Company, SKIN. In my opinion, I would say puts. Next company I wanted to look at is ORGN Materials. This company we spoke about, and as you can see, basically fell off a cliff, and a lot of people were getting very upset. They were saying that they misled their investors and they botched their timeline, so everything got delayed, and then it was also going to cost like several billion more. So everyone's been kind of beating this company up. And if we look in the numbers, we could potentially make the argument that it's not that bad. We have estimates coming in here, a loss of 14 cents a share on revenue of 12.2 million. Company's market cap now sub 85 million. What I'm concerned with this company is the fact that they may continue to beat it up because of the previous negative news that has come out. However, of course, if the company beats here on this 12 million, we could potentially see a pop maybe to this trend line. Again, these are just my personal trend lines, but in my opinion, if the company does happen to beat these estimates and actually reports some decent news, we could have a pop here from 58 up to about 78 cents. However, if the negativity continues, we may actually crater all the way down here to this bottom trend line of about 40 cents and potentially ride to the bottom fib there of 36 cents. And I'm only saying that because, again, I'm not trying to beat up the company, but last quarter here, you can see estimates jumped up to 14.88 million because the company was supposed to be on a certain point in the timeline of their schedule. And again, they mentioned that a lot of these situations got delayed. So now we can see that the company missed by about 50% here, posting roughly 7 million on estimates of almost 15 million. So now we're back up here and in 8 figures with estimates of 12.2 million. So unfortunately, it's very, very difficult to call, in my opinion, because technically 1.7 million, 6.9 million, we'll call it, slightly over 7 million. So the jump quarter over quarter obviously was very, very tiny and came nowhere near these estimates. So what I'm trying to say is, if everything's delayed and they can't generate the revenue that they supposedly forecasted, now moving forward here with this 714, if they post like 8 million against this 12.2, in my opinion, Wall Street is going to absolutely decimate this stock. But again, it's hard to call because they could be turning it around and the company could post, who knows, 11, 12 million. They could come close. Maybe they come in with this 13, 14 million mark that they, should have posted this quarter, but now they're posting this next quarter. So in my eyes, it just seems hard to read because I just feel like there's a black cloud now over ORGN. I just feel like everyone's got a bad taste in their mouth and people are just no longer interested. Again, market cap 84 million. Look at the PE here at 165. The EPS, the losses have been more narrow than analysts have expected. And you can see it's kind of been maintaining itself for the most part, remaining flat over the last 4 quarters. And you can see that expectations were continuously dropping. And that's not what the company has been reporting. So the losses in check, again, this could be an immediate short-term kind of sell-off crappy situation that could materialize and become something pretty worthwhile here. We can see, again, the revenue has been increasing. Let's check the financials quickly. We can see, again, look at the, we have assets significantly outweighing liabilities here. Almost 10 to 1 here. Assets minus liabilities yields equity. We can see the equity, for the most part, has been consistently increasing, getting up to 424 million. The company only having 7-8 million in debt, roughly. Not necessarily a red flag. The book value per share has been steadily increasing quarter over quarter up to almost $3 a share as of last quarter. Stock currently sitting at 58 cents. We do have the revenue coming in. Operating expenses jumped up 30-40% from where they were several quarters ago. The debt, yeah, not really. Again, see, the problem is with a situation like this, and I know technically I'm making a video and just giving my personal predictions, and I always say it's easier to react than it is to predict, right? But, sometimes we like to take a shot and get some action here with some of these earnings plays. But honestly, in my opinion, with something like ORGN here, I personally wouldn't even play it. I don't even know if I even feel comfortable throwing out a prediction. And again, we all know no one's perfect, and of course you could be wrong, but I literally have no idea where this stock is going to go because I just feel like the company hasn't proven itself to us yet. And that's what I always say, right? In my opinion, anyway, try not to, time the absolute bottom and try to look like that financial genius. Like, forget about it. Let the company report their earnings, and then you could react off of said news because right now it's unpredictable, right? And like I said, if they miss big and they come in and they post like, 7.3 million and just show a slight bump and miss by 5 million in change, trust me when I tell you, they will probably continue to bash the stock and it's going to drop to new lows into the 40s, in my opinion, and potentially the 30s. But if they do somehow post like 12.5 million and they beat on that revenue number, then the stock again is going to pop up, probably, in my opinion, back into the 70s, possibly 80 cents, get above this personal trend line that I have drawn out. And you can see we've been in this downward kind of consolidated channel here, the sell-off, and we have the potential on this news to pop up here into the 80s and get back to or potentially above these resistance trend lines over here. So in my opinion, again, I would be more of a wait and see because, again, the way I look at it is here at, roughly 58 cents, even though some of the fundamentals are potentially lining up in our favor, in my opinion, it's still unpredictable, and I would rather wait for the good news and buy in at a higher cost at 70, 80, 90 cents a share, as opposed to just rolling the dice here at 58, just hoping that it's going to pop, and then all of a sudden, it's bad news and the stock goes from 58 cents down to 38 cents, right? In my eyes, you probably wouldn't want to take that immediate hit. So In my opinion, I would actually be wait and see mode here with Origin, but I did want to show you guys like the book value per share and the asset to liability ratio. So not necessarily bashing the company. They essentially shot themselves in the foot and kind of caused this whole sell-off and loss of investor confidence, we'll say. Next stock I wanted to look at here, very interesting one, Navitas Semiconductor Corporation, ticker symbol NVTS, listed here on the NASDAQ. Of course, tech company, semiconductor company, so, we assume bigger and better things, but the stock has been bouncing around, as we see here. $6.15, up 38 cents, a little over 6.5% on the day. People seem pretty pumped about this stock. As you see, Navitas powers Samsung Galaxy S24 with integrated AI. So the company, signing these deals right now, market cap 1.1 billion for a semiconductor company that's actually bringing in, tens of millions of dollars. I guess I could say in my eyes, it's not that crazy overvalued. Company still losing money per share, pretty volatile. Beta 2.6, again, the beta volatility of the stock in relation to the overall volatility of the market. This company performing pretty well on the EPS side, as you can see, posting consistent, narrower than expected losses, 4 straight quarters in a row. EPS estimates minus 5 cents a share on 25.438 million. And if we look, we can see basically steady increases in revenue quarter over quarter with going with a little net income positivity here as of last quarter. Year over year, we can see slowly growing here, tens of millions. In 22, they finished the year about 37.25 million, and we're expecting 25. So just some quick arithmetic here. This will be about 31 million. Plus that'll be what, like 53 million. Plus that'll be about 78 million. So looking at it like that, I mean, revenue, again, if the company comes close, meets, or beats that revenue expectation today, then it's basically going to show us that revenue has increased about 100% year over year. So in my eyes, this company definitely trending in the right direction. And we definitely could make the argument that it is overvalued, of course. Bringing in 80 million with a $1 billion market cap could definitely be viewed as overvalued. But also, more importantly, the debt here, we can see 11.2 down to almost half that, 6.5, 6.7 million, 6.3 million, 6.13 million. So it looks like they're keeping the debt in check and potentially slowly paying it off as they can. And this blue bar here, which is the cash and equivalents, you can see was slowly ticking down, and then 2 quarters ago jumps up to 177 million, last quarter 176 million. So the company holding some decent cash on hand. We're seeing consistent increases in revenue quarter over quarter. This is going to be a big quarter. Again, revenue has been jumping up a couple of million a quarter, it looks like, but now going from 22 to north of 25 million, in my opinion, this is going to be a milestone quarter. And because, in my opinion, the company could be viewed as overvalued, if they happen to miss that number, Wall Street is more than likely going to beat the stock up, probably $5, sub $5, in my opinion, if they miss. However, assets are outweighing liabilities. We switch over here, we can see that, yes, the revenue has jumped up. The cost of goods is just slightly below the revenue being brought in. However, it is profitable. Revenue minus cost of goods yields gross profit. We can see the last couple of quarters, 2+ million in profit, back to where they were after taking that dip down. Operating expenses basically in line here, sitting at about 31 million as of last quarter. Profit minus operating expenses yields operating income. We can see the operating income still sitting negative. However, it was, minus 30 million. Was a little bit better than it is now, but at least they got it back into the minus 20 millions. So, could be worse. Assets outweighing liabilities here. And we can see that even looking back to Q1 of 22, you can see that liabilities were sitting at about 87 million. Now, all of these quarters later, liabilities only up to 90 million, but assets have gone from 286 million up to 493 million. So assets growing nicely. Liabilities appear to be kind of kept in check. Assets minus liabilities yields equity. We can see for the most part the equity has been stable around this 380 million mark for several quarters and now jumping above 400 million as of last quarter, bringing the book value per share slowly ticking higher here after that drop down for the last couple of quarters. And we can see book value 226. Let's check some other numbers here. Price to sales, technically the lowest it's been going back the last several quarters. Price to book sitting at about 2.5, not the lowest it's been, but for the most part, it was looking like, above 3, 4, and here above 6. Return percentages were better, increased quarter over quarter. Gross margin percentage fell off a cliff, as we see, was up here north of 40%, completely dropped down here to single digits, gets back to the mid-teens, and then drops about 30% quarter over quarter, dropping from 15% down to about 10.5%. The operating margin, as we see, for the most part, is steadily, well, not really steadily, actually, it's bouncing around, but has come a long way over the last several quarters here, from minus 500+%, now sitting at minus 130%. And same thing with the EBITDA as well, minus 500+%, clawing its way all the way to minus 100%. Net margin percentage we looked at went positive last quarter, 34%. Inventory turnover seems to be increasing. This is what I mean. The revenue does seem to be steadily stepping higher, which again is why I always say you want to find a company, in my eyes, that's kind of in this situation, but in my opinion, you want to buy it at a fair or discounted price, right? And we could say, again, 78, 82 million, whatever the number is for the year, the market cap right now is 1.1 billion. So we're trading, over 10, 12, 13 times that yearly revenue number. So this is why I'm saying, again, is it necessarily a bad buy at this price? No, of course not. But if you want to start piecing your way in here at the 6s, at the 7s, but all of a sudden the company comes out, and as we see, they're riding high off of this consistency. So if they miss that revenue number today, like I said, they're going to take a hit, and they're probably going to drop to $5, potentially sub $5. So if you are piecing your way into this situation, that is, in my opinion, how I would play it. I would piece my way in slowly, and then if the market decides to sell off after being at these highs for quite some time, or if someone comes out and downgrades Navitas or lowers their price target, all of a sudden, again, it dips into the 5s or the high 4s, then, it would obviously be a much more attractive price, a much more grounded, realistic value, in my opinion, and then that's when you can go in a little bit heavier. But in my opinion, I have to say, honestly, tech's been flying high. And again, this is a semiconductor company. And for the most part, let me see, actually. Yeah, the EPS side has been very, very consistent here. And the revenue side as well. Again, going back to Q4, this time 2 years ago, the company slightly missed by less than 1%. And then since then, hasn't missed at all and has been consistently growing with revenue up roughly 200% from that point just in the last 2 years. So they're expecting a slight dip of about 1 million for next quarter, but then expecting more growth here, as you see, 28 million, 36 million. And if we look annually here, we can see as well, again, looking to close out the year at a touch below 79 million, but then almost doubling that up to 130, 230, 400 million. So if you're pumped and bullish on this stock, I can appreciate the reason why. But again, I would try to pick my spots. But overall, I guess I'll go on record and I'll say, again, semiconductor company consistently have been beating earnings for the most part on both sides. And revenue does seem to be steadily increasing with bigger forecasts down the road. So in my opinion, yeah, in my opinion, I think it goes higher. I do think it goes higher. Because again, like my gut is telling me personally that it's really going to go lower. And it's going to drop down here and potentially drop down to this fib here at 422. In my opinion, that would be 110% justified. But all I'm thinking about is what happened with AI yesterday. right? And that's what I mean. AI technically was overvalued. I know they came out and they had a decent quarter, but in my opinion, that stock really shouldn't be up. And it popped up today and it's been staying up. So I guess for Navitas, I would say calls, in my opinion. Here I wanted to look at Hewlett Packard Enterprises, ticker symbol HPE, listed here on the New York Stock Exchange. Stock $15.13, up 27 cents, about 1.8% here on the day. We have a market cap of about 19.2 billion. The company paying a nice dividend, yielding 3.5%. The PE sub 10. And in my opinion, I actually think this stock is undervalued looking at the big picture. We can see 4 straight beats here for the last 4 quarters on the EPS side. EPS expected to dip down a little bit more, actually, to 45 cents a share. Revenue of 7.089 billion for the quarter coming in. And we can see that, yes, the revenue has dipped down here to the 7 billion mark, but they technically didn't drop below 7 billion. And then for the last 2 quarters, have been increasing and clawing back up to 7.33 billion. And again, we're slightly dipping down to 7.08 billion. So in my opinion, I would say that the company probably has a good chance to beat. It looks like they turned the profitability around, bringing net margins back up to that 6% range. Last quarter, 8.75%. And if we look annually, we did dip down from 28 to 27 billion. 27.8 billion, 28 billion, 29 billion. So this is, I feel like this is a slow climber. Let's check the forecast out of curiosity. We have 16 analysts looking at this stock, 2 giving it a strong buy, 2 giving it a buy, 12 saying to hold. So no one is on the sell side here. And we can see that even though we're having these estimates dip down to the lower 7 billions, we can see moving forward, the company is expecting revenues to grow as well. Mixed completely down the middle here on these expectations, beating 4 of the last 8 quarters, missing 4 of the last 8 quarters on the revenue side. EPS side, again, 1 miss in the last 8 quarters. Annually, the company looks pretty inconsistent as well. 3 beats, 5 misses on the annual side. On the EPS side, the company is rocking and rolling, though, I will say that. However, overall, in my opinion, I mean, we have a company bringing in, $29 billion, and they're worth $19 billion. So let's check some other numbers here before we, give it that go signal, in my opinion. Dividend 48, maintaining 48. Okay. Not increasing the dividend, I understand, could be viewed as a red flag. However, in my eyes, even if they're quote-unquote struggling and being kept down, the fact that they didn't cut the dividend, in my eyes, is actually a green flag. The debt was up here to 17 billion 2020. Looks like it's been slowly stepping down here. 13, 12, back up to 13, back up 13, 13 and a half. The cash has increased nicely. Up here, 3.68 billion, along with the free cash flow has been consistently increasing. That's this middle bar here, the green one. You can see minus 1.6 billion, up to positive 200 million, 850 million, 2.17 billion. So it seems like the company is kind of turning around, especially on that profitability side. However, we do have short-term liabilities outweighing short-term assets. Looks like they got costs in check, kind of for the most part. Last time they were well above the $7 billion mark. You can see cost of goods, 5.3 billion, 5.2 billion. Last quarter, 7.33 billion. Cost of goods sold was sub 5 billion. So in my opinion, that's actually a green flag. Revenue minus cost of goods sold yields gross profit. We can see we're kind of maintaining this 2.5 billion for the most part for the last several quarters. Operating expenses seem to be consistently increasing for the most part. Gross profit minus operating expenses yields operating income. We can see that has been steadily decreasing for the last 4 quarters in a row. Switching over here to the balance sheet, we could see that assets are outweighing liabilities. giving us about 21.25 billion in equity, which is the highest it's been going back about the last 6 or 7 quarters. Book value per share bouncing around, got back above that $16 mark though as of last quarter, 16.51. PE back down here in single digits, was double digits for 4 quarters in a row. Price to sales basically in line. Same thing with price to cash flow. Price to book now sub 1, but it's been sub 1 before. Our return percentages are climbing nicely here for the last couple of quarters. Gross margin taking a hit for the last 2 quarters, going from 35, sub 35, down here to the 33s. However, technically higher than where it's come from, so not exactly sure if that's a red flag, even though it went down quarter over quarter. Operating margin, yeah, basically in line, climbed to almost 9%. It's been dropping the last couple of quarters. EBITDA, same thing. Net margin percentage actually heading higher. Inventory turnover seems stable. Asset turnover not really moving. Our debt ratios are decreasing. Yeah, in my opinion, 709 billion, huh? $709 billion. Last time it ticked up from Q4 to Q1. Yeah, in my opinion, I would say HPE. I would say HPE calls, in my opinion. What else did I want to look at? NTAP. NTAP has been on the up and up, as we see. About 18.25 billion market cap, paying a little over 2.25% dividend. PE 27. Good beats, 4 quarters in a row on the EPS side. Yeah, revenue seems kind of sporadic. 1.4, 1.5. We're expecting 1.59. Really? This time last year, 1.52. Dropping from 1.67. So 1.56 going up to 1.59. That's interesting. Annually, though, you can see the company took a dip kind of going into that 19-20 range and then completely turned it around here. 6.25 billion, we'll call it 422. Only trading about 3 times annual revenue right now. Let's check the financials quickly. Nice beats, nice consistent beats there on the EPS side. Revenue side, a little bit more sporadic. 5 beats on the last 8 quarters. And they're forecasting just basically maintaining this 1.5, 1.6 billion range. Increased dividend 2 years ago, maintaining. PE is now the highest it's been. Price to sales is now the highest it's been going back the last several quarters. Price to cash flow. Trading over 23.5 times book value right now. But our return percentages have taken a big hit here quarter over quarter. Gross margin has climbed up to over 70% though. Operating margin was up slightly above 20. Drops down to 14, back up to almost 20. EBITDA was north of 25, drops to sub 20, back up to 23. And the net margin percentage Yeah, we've hit 15 a couple of times, had that big pop and then that big drop, and even back down to about 10. Now we're sitting at about 15. Inventory turnover looks like it's been slightly slipping. Asset turnover was climbing and then dropped and is now kind of back to where it was. Assets and liabilities pretty close. Still positive equity though. And we can see the book value per share, as you see, was dipping down here to about 3, jumps up to north of 5.5, and held that mark for about 3/4. Then drops back down into the 4s and then back down into the 3s. So with the stock up here at 89, we could potentially say, in my eyes, I think there is a good chance that this stock goes down. Again, I know people will say, well, you always look at revenue and market cap, so don't you think it should go up? Yeah. Look at the cash consistently decreasing here. $4.5 billion back in 2020, down to 4.1, down to 2.3 in 22. The debt, 2.7, 2.68, 2.67, 2.66. Okay. Free cash flow bouncing around, was up above that several hundred million mark. Now you can see for last quarter down to 97 million. And the cash, again, 267 down to 264, 232, 193. Yeah, in my opinion, I actually think it does get rough in the immediate short term before it gets better. The stock currently at 89. We go to gap fill from last quarter, would bring us to about 79, roughly a 10-point drop. In my opinion, puts on NTAP. That is just my opinion. Fisker, of course, everyone loves their EV stocks for reasons unbeknownst to me. But we come in here, someone asked me about this down here at 75 cents. I said forming a potential descending triangle should drop down to roughly 50-cent range. As you see, drop down, hit new lows of 52 cents, and have since bounced off that low, probably running on anticipation of these earnings. Going back, we can see estimates back here. We're supposed to be 49 million in revenue. The company didn't even do a million. Now we fast forward, you're supposed to be above 100 million. You posted 71.8 million. Definitely nothing to sneeze at. That's a good chunk in revenue, right? Now estimates are jumping up to 327 million. So you have to ask yourself, has the business, has revenue, realistically, quadrupled in the last 3 months? And in my opinion, I would probably say no. As we see, market cap just a touch over 400 million. Company missing on the EPS side 3 of the last 4 quarters. Estimates of a loss of 23 cents per share coming in. Again, we went from the thousands up to the tens of millions as of last quarter. However, of course, to make 71 million, it cost 95. That doesn't help us at all. Forecasts are still high because they don't update themselves. 4 analysts on the strong sell side. That's interesting. I usually don't see that. And look at this expected growth here, though. I will say, absolutely phenomenal. If the company can actually do this, the stock is going to absolutely explode, probably up to like $5 or something. If all of a sudden we're bringing in hundreds of millions of dollars, that's what the market cap is, right? So, in my opinion, if the company, I don't know. I mean, obviously, if they beat, it's going to go up. But I don't know. That's a big jump, man. That's a big number. That is a pretty big number. I cannot lie. I'm just being real with it. Debt, 1.18 billion. No. Oh, my goodness. Debt jumping from about 700 million up to 1.18 billion as of last quarter. Free cash flow, the green bar in the center, minus 143, 144, up to minus 129, minus 219, minus 338. Cash 625. was consistently decreasing. That's the first time it ticked higher. Assets outweighing liabilities in the short term, not in the long term, though. It cost $143 million to make that $71 million. So this is what kills me about these companies, right? Because even again, with these higher forecast revenue numbers supposedly coming in, 320 million, whatever it is, it's like, even if they come close to that number, let's just say they post 300 million. Based on what we're seeing here, it's going to cost them 600 million, 700 million to make that 300 million. So this is what I'm saying. It can't really be sustainable. I just personally don't see it. Operating expenses have fallen down, though. I will say that the operating expenses did get in check, and even though, of course, this is negative and it yields negative operating income, this is a very big drop here in operating expenses. So that is a good sign. This looks like this is the worst sign. We're moving. Assets outweighing liabilities. You can see, though, the equity has been consistently dropping for the most part, minus that quarter. Almost 700 million in equity back in early 22, now sitting at sub 350 million in equity. Yeah, the debt popped up. The book value per share consistently dropping down. You can see now, as of last quarter, Steam Friend, my apologies. You can see now book value per share as of last quarter, 99 cents. But I just think personally, again, I would rather react to good numbers than try to predict the bottom. But in my opinion, I just think that this number is too high. And I think regardless of what the company posts, they're probably going to miss this number. And even if somehow, some way they meet or exceed these expectations, chances are the costs are going to outweigh said revenue. So it's still kind of going to be viewed as a negative, really, in my opinion. If earnings are positive, we could have a pop back up here to the 20-day moving average, high 90s, potentially $1. So you have the potential for about a 33% move here, in my opinion. But I actually think it reverses back down to 50 cents and makes new lows. In my eyes, I would not be a buyer of Fisker. Dell has been absolutely raging, in case you haven't realized. The stock's sitting here a little over 94.5. Market cap 66.7 billion. PE a touch below 26, earning $3.69 a share, beating 4 quarters in a row on the EPS side. The revenue did take a little bit of a dip down into the lower 20s, but the profitability has been turned around. On the annual side, getting up 101 again. Estimates of 22.16 billion. This time last year, revenue increased from Q3 to Q4. Expecting a slight decrease from Q3 to Q4. So I feel like the revenue may be taking a slight hit, and they're trying to pump up the profitability side of it. We can see, though, that now liabilities are outweighing assets for the most part all the time here. Company sitting with negative equity, book value negative 373, debt of 27.5 billion. Granted, it was roughly 10% higher, above 30 billion, but that's a big chunk. We're talking what, like 35-40%? Well, maybe not that much, but yeah, 30 plus percent of the market cap is debt right now. Operating expenses have decreased. Yeah, I don't know. The debt was much higher. Company holding over $8 billion in cash right now, but I just feel like the immediate short term, I'm actually going to say puts on Dell, in my opinion. I'm going to say puts on Dell. I really am. I even though, again, the revenue to market cap, and I know they're holding some cash, but in my opinion, this is pretty high, pretty quick. If we see when the ball dropped here, the stock was $39, $40. Now it's sitting here at $94. Even though technically we could make the argument that revenue has plateaued. And of course, quarter over quarter, for the most part, has been lower throughout 23 than compared to 24. So, in my opinion, I would say puts on Dell. And the last one that everyone wants to look at is SoundHound. SoundHound having a big day today. As you see, call it 7.25, up 90 cents, over 14%. The stock at one point was up to 7.58. You can see has come back down, bouncing around. We have earnings coming out today. Estimates $17.747 million on a loss of about 5.5 cents per share. Market cap is now up to $1.77 billion. The company losing almost 50 cents per share. The EPS seems to be steadily climbing here quarter over quarter, missing 2 of the last 4 quarters, beating 2 of the last 4 quarters. But in my opinion, as I said, when I basically, for the most part, every time I looked at this stock, I said, in my opinion, the main thing that I feel personally, in my opinion, that analysts and investors are going to be looking for is the growth in revenue. And you can see for the last several quarters here, dropping down from double digits down to 9.5, 6, 7, 8.75, 13.27, now 17.74. And with the company basically letting us know that they've been consistently signing new clientele here, getting all these new deals. And now, of course, you got SoftBank with the position. You got NVIDIA disclose their position. Anytime an AI or tech stock goes up now, SoundHound's going to go up higher. So, of course, we definitely could make the argument that now the stock is pretty high and pretty overinflated. But I just feel like the word is out. And now because people are so upset that they missed it and they kind of didn't know what we know, right? Basically, they're kind of beating themselves up saying, wow, this thing was $1.60, it was $1.90, it was $2.20, I missed out, I could have bought it, now it's at $5.50, I don't care, I'm buying it. Now it's at $7, I don't care, I'm buying it. I'll add to it over time, and I'll tuck it away for the next 5-10 years if they become huge. So that's what I feel everyone is going to, that's basically the mentality, in my opinion, of everyone in this situation. And again, this stock definitely could come cratering down. Even if they beat earnings, the stock can literally drop about 50% back to like 3.5. No problem, in my opinion. But again, I just think that the word is out. And I feel like something's telling me they're going to come in above this expectation. I really do believe that. I really do believe that. And again, as I mentioned, the CEO himself said that the company was approached several times. Okay. And now with the stock flying high, and if they come out with another beat, I think it's just going to enhance their value for the longer term. And even though in the immediate short term, we might say, wow, 1.8, $2 billion market cap maybe, that's way too high. The company's not worth that much. Again, they look at this based on future revenue and future earnings. So if there are people looking at this company saying, yeah, $2 billion, let's say we offer them $2.5 billion, $3 billion to buy them out. Yeah, in the immediate short term, it seems like, we got screwed and we overpaid. But in the longer term, we're expecting, to utilize this technology this way, and we're forecasting, who knows, 400-500 million a year off of revenue moving forward. You know what I'm saying? So if people are seeing value like that, then yes, it may hurt immediately to spend and write a check for a couple of billion to buy them out, but over the years, it may, come back and pay you back tenfold, 20-fold maybe, who knows. But overall, in my opinion, honestly, SOUN, if you're in shares at a much lower price, in my opinion, I personally always like the stock, and and now we can see it's gaining some momentum. So obviously, you're up big if you've been following my channel and my personal opinion. So if I was in shares, I would not sell my shares, and if I was in shares, I would buy puts to protect my downside and hedge my position, right? Because why would I give up my shares that I bought at 2, 3 and change with the stock sitting here above 7? Who knows what other catalysts can come out on this stock, right? We're seeing it now popping off of every little thing. So who knows what could be said? I mean, even if these numbers are low, if they come out and forecast, huge growth moving forward now above expectate, the stock might take off and go to $9, $10 a share. You understand what I'm saying? So even with it potentially overvalued in the numbers, I personally wouldn't get rid of it. But shout out to the whole crew, especially the guys over in the Discord and all of my earlier subscribers. I know a lot of you may have come in recently, but shout out to all my earlier subscribers, because we originally started looking at this stock, I think it was back at like 180 or something. I was doing updates on the technical side. I was updating like every month and every couple of months when they reported earnings on the revenue growth, constantly saying, in my opinion, the stock is definitely going to be a nice long-term player. And we can see here in the short term, it's already up several 100%. So shout out to all you guys who kind of were in the know and knew about this situation before it really started to take off and gain traction. But that's basically the way I would play it. If I was in shares, I would try to hold. If you can do options, I would say, in my opinion, grab some puts, protect the downside. And, if it does drop to 5 or 4.5 after these earnings, at least, number one, you'll still have your shares. And number two, you'll make a couple of bucks in the short term on the put side, obviously. So I'll end it there. But once again, stocks by the numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, let me know down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand markets are rocky and volatile and very uncertain. I want to wish all of you success. I hope everyone makes a couple of dollars. If you guys are jumping in these earnings plays, let us know down in the comments section. And I wish all of you the very best of luck. Have a good day.